A warm welcome to the Risk Reversal Podcast. You might see 5 of us here. This is special, by the way. If you're just listening, you don't see any of us. Maybe you should check out the YouTube page. Smash the shit out of the like button, the Risk Reversal Podcast. But I'm Guy Adami, always joined by Dan Nathan. Dan, how are you?
I'm doing great, Guy.
The very handsome Danny Moses.
Amazing. You're a cross between the greatest game show host ever and Tony Bennett right now with that microphone in your hand.
I like to think a little Dean Martin. Dean was cooler than Tony, but I hear what you're saying.
I like the Dean Martin. I'll go with that.
Go with Dean Martin.
Okay, I'll go with Dean Martin.
Of course, on my other side is Vincent Daniel. Vinny.
Guy, pleasure to see you.
Beautiful haircut, by the way.
That guy did it for you.
I appreciate that.
Got it today, actually.
You look very good.
Thank you.
And the man that always looks good, the only Olympian amongst us, that would be Porter Collins. Hello.
It's great to be here. I feel like I'm on Squawk Box. I'm like Andrew Ross Sorkin. We got Joe Kernan, and of course,
I don't know where you're going with that.
Fleeceman.
Yeah.
Steve Fleeceman.
When we come back.
Here.
There's a lot to talk about. I'd like to start with Vinny because we're paisans.
Yes,
and,
sir.
you know, we got to keep it real here. The market goes up every single day. This is in the midst of a government shutdown, in the midst of China, U.S. rhetoric getting ratcheted up, in the midst of valuations being at levels we've never seen historically. I can rattle it all off, yet you have a market that continues to sort of grind. So as you sit here today, does anything sort of stick out to you, sir?
In terms of what?
In terms of just the strength of the broader market, the index, the S&P 500.
It just reminds me, Porter and I try not to think about markets these days. The less I think about it, the better off we do. But if I take a look at it and see, it feels 99 to me. It feels like that era. There are differences, clearly, but it's the same thing. New technology, massive investment.
Right.
Investor speculation in that investment and everything around it. Valuations don't matter. And people are leveraging up, corporates are leveraging up to get into this technology. The problem I have with all of this is let's rewind the clock, right? We get back to Prince 99, back to electric blue shirts that probably we wore. It could last a year. And so the timing of it is my issue.
All right, let's just stay with that for a second because Paul Tudor Jones was on with Andrew Ross Sorkin, I believe last week or week and a half or so ago, and he mentioned what you're mentioning. I'm not saying you're sort of copying him at all, but he said it feels to him like October 99, but then he was quick to point out from October 99 into early 2000, the NASDAQ went up almost 40%.
Q's, I think, doubled from September 99 to March of 2000.
So think about that, which is a pretty remarkable move. Now, what I will say quickly is I think things happen a lot faster today, and I think there's some things around the valuation curve that are a little bit different, but, you know, you bring up the same types of things that he brought up.
Right. I'm not advocating, therefore, I'm not the person that says, therefore be bullish because I don't know the timing. It just feels the same way. And who knows? We might have a proliferation of debt like we haven't seen since those days in certain aspects of corporate. So we're just watching it, and you know, we're nervous. We're very nervous about it. But it's also possible that the next 30% is up rather than down. I'm going
to flip across the desk to your castmate who did not have a speaking role in the movie, unfortunately. But you look good, or the person that portrayed you look good.
Okay.
Same type of thing, Danny. I mean, you and I do these things. We do market call from time to time. I find myself perplexed, flummoxed, whatever word you want to use in terms of the market performance. But do you see any similarities between what we're seeing now, 99, or any other period of time for that matter?
Yeah, I talked last week. It reminds me of 99, but there is a piece of 2008 here as well. And it's not as cataclysmic as 2008, not even close. But from an underwriting perspective and credit, right, we're in the first inning potentially of just credit that degrades slightly will have a big impact, I think, on the markets. But, you know, I'm looking around the market right now, and I just look at gold, right? We will go into that later. But gold's acting like this now. Now it's acting so well that it should scare people.
Right.
I mean, gold going in a straight line up, 30% in the last couple months, that should scare people. It's a $30 trillion asset now. Bitcoin now not acting well. Why? Because it's more of a retail component, I think, just on the margin. Other things, things don't feel right now. Meanwhile, while all this is happening, the 10-year yield's hovering at 4%. The be-all, end-all, the most important thing, but it's going down now potentially for the wrong reason. So government shutdown, credit rearing its head, gold outperforming everything. People are going to start to ask questions. So this feels, to quote another Adam McKay-produced show, I can feel it in my plums. I can feel it in my plums.
What are your plums?
That was the Will Ferrell when he was, the car dealership.
Eastbound and Down.
Eastbound and Down, one of the greatest shows ever.
Kenny fucking
But
Powers.
I feel you can. I feel
You're
something.
fucking out.
By unlike Vinny, who's trying to do this 52-48, maybe up, maybe down. The next 30% is definitely not up.
Okay.
Okay, in my opinion, I don't know when the down's going to come, but I'll take over 30% down for 500.
So there are 5 of us at this desk. I think 4 of us are very emotional people. I know that I am. And I'm half Sicilian, half Italian, as I've said. So I can easily fly off the handle. The one person at this desk that is not that way is Porter Collins. Now, you're able to,
It's not
you
even his
remain
real name.
agnostic.
It's not even his real name.
What is your real name?
What's your real first name? Oh, what is it? I thought there's an A in front of it somewhere. All
A.
right.
Porter Collins.
Yeah, A.
That
Porter
would be,
Collins.
That would be
Yeah.
perfect.
Yeah.
So question to you. Since you're able to sort of take the emotion out of this far better than at least me, how do you sort of look at the landscape? Is there anything out there that's keeping you up at night, or is there anything out there that's exciting you, saying, you know what, I'm pretty geared up about what I'm seeing here?
Funny you say that. I probably get geared up the most of anybody because I'm sort of a little bit hyper competitive sometimes. But I'll take the opposite view of my partners, just because I feel like it. We're in a bull market, right? We're honestly, I can't believe I'm saying this. We're in a bull market in bonds, starting to be. Yields are going down, not up. Gold is having some parabolic move. I don't know what that is. Maybe it's revaluing the whole system. Maybe this is an inflationary speculative bubble going on. Equities keep going higher. Russell 2000 is, as until today, has been breaking out. So I don't want to fight the underlying trend, right, which is a bull market. And yes, there's stuff along the way, and there's, obviously been, I guess, 3 or 4 frauds in credit right now. But, some of those frauds, like the one uncovered today, it was a, commercial real estate fraud going back 10 years. And so these take time to unravel, right? And so, and we talk a lot about a tech bubble, but they're spending a lot of money. And, if AI is going to be as good as we think it is, and as everyone thinks it is, they're not going to charge us $20 a month for it, right? And if they're going to replace humans, it's going to be a lot more costly than that. And so, listen, there's plenty of reasons to be bearish, and I can turn in a second. But right now, it looks to me like a bull market.
What I'm hearing is there are times when you just have to acknowledge what's going on in front of you and sort of ride it out and sort of ride the wave. And people like Guy Adami, who try to sort of nitpick all these different things, he's going to be right eventually. But, in the meantime, he's sort of getting steamrolled. And that's not directed at me, I know, but there's a truth to that. I am guilty all the time of not seeing the forest for the trees. And, David Tepper talks about it a lot. Don't make this more complicated than it needs to be. But at some point, Dan, there's this inflection point. And I know you have a lot to say in terms of the correlations between now and 99 and other periods of time.
I guess I'm more focused on 2020 and 2021 because a lot of the activity that I see, the speculation, SPACs are coming back. I think there's been 170 IPOs this year, which is up dramatically. Obviously, we've had this window that's been closed. 100 of them are SPACs. Look at what's happened again in all these shit coins. Look at the concentration and the leverage in crypto, right? We're seeing some M&A. We're seeing really easy monetary sort of situation here. The CME Fed Funds futures, the tool is suggesting that by the end of the year, we're going to be at 3.75 on the high end of, Fed funds, right? So money's getting easier. And I don't disagree with you, Porter. Like we could have another leg to this bull market here. One big issue, though, the disconnect for me between the stock market and the economy is that in 1995 through 1999 or 2000, GDP was averaging 4.5%. So think about where we are right now. This is post-COVID. We are not really accelerating GDP right now if you think about just where we're going to end up this year. So what's gone on with this economy, right, that we don't have, accelerating GDP right now? Don't you think there's a bit of a disconnect, especially when we're seeing Fed funds is going to be well below where it was, right, back in 2000. I think it was like 5.5% or something like that. So I guess I've never seen a market so disconnected from an economy, and that's happening right now. And when you think of the contribution of that internet infrastructure build in the late 90s, it was probably 1-2% of that sort of GDP number. Now, obviously, this infrastructure build is a huge part of it right now, but I think it's so narrow right now. I think you see other parts of the economy that are just not participating. We have a weakening labor market. You could have interest rates go down. It, to me, has more to do with the weakness in the underlying economy away from infrastructure build.
But Dan, I'll push back. There's no rule that says the stock market has to equal the economy. Like, that's the only thing, right? There's no handbook that says, the stock market's got to follow right along with the economy. I think we all acknowledge, and the data says the economy kind of sucks.
But I think I would add to that, though. I think
maybe this is an inflationary boom that you have to understand that maybe something different's going on here.
I think the wealth effect is having a huge impact on consumer discretionary in a good way, and the market and people. If the market were to reverse, like down 10 or 15%, I think it would self-fulfill the same way we've seen it. That's not to make a valuation call per se. And as it relates to the earnings of today versus back in 99 period, without the growth in GDP that we don't have now, I would argue that companies are using technology now to make themselves more efficient and cost-cutting in ways that you probably couldn't see. They may be one-time in nature, so there's a readjustment higher of efficiencies in some of these technology companies.
So you have thoughts, Vinny, and I want to ask you a question, but then throw some stuff on top of it. The Fed pivoted in Wyoming a couple months ago in terms of being concerned about inflation, and they said, you know what, we're still concerned, but the job market concerns us more. Porter just said the economy probably on the margins sort of sucks. I agree with that. If you listen to a lot of these retailers, the trade down is in full force. Look at Walmart at an all-time high, which makes sense to a certain degree, but it also speaks to the trade down that they're seeing. So there are certainly cross currents out there. The one thing that's changed since 99 that you mentioned is this advent of passive investing. And Torsten Slok just did a piece about it. Dan and I talk about it all the time. And I have brought up, with passive investing being sort of the thing over the last 5, 6, or 7 years, passive investing doesn't care about the things that I care about. Valuations don't matter. Headlines doesn't matter. The funds fly into the market regardless of all these things. And passive is great on the way up, but the leverage it creates is really bad on the way down. And we've seen glimpses of it. We saw it in April to a certain extent. I think we saw it on this past Friday when the market cascaded lower. When passive becomes active, it's never active on the way up. Anything around the edges that is sort of alarming to you?
I'm going to give you a little bit of a different answer than what you gave. I don't think Liberation Day was a passive issue. Although people would disagree, I don't think Friday is a passive issue. So there's two forces in the market one is damn straight passive, right? Every day, people get their W-2s, put it in target date funds, it goes to 20 to 30 names. And they don't care about us. The other part of the market that we talk about ad nauseum is the vol targeting market. These huge hedge funds that are levered 6 to 7 to 1, the amount of capital they have outstanding is a function of volatility levels. The lower the volatility, the more gross they have out there. So when you get to low VIX levels, I start shaking because I know if you have a vol moment, these guys have to sell. Liberation Day was a function of the fact that Citadel and Millennium were all in, I think, I don't know for a fact, but all in, volatility came and they had no choice. They have no choice but to sell. It's not like there's a human making that decision. The risk manager says bring it down, and so it goes. So those, I think, are the two dominant things that happen in the market. When it comes to passive,
well, even that's the opposite of one should invest, by the way.
100. Well, that's why we're not there.
We'll
anymore.
have Porter bearish before this episode.
No, but like that's not a bearish thing. That's just a structure thing. Right. The one thing that I would get nervous about passive at some point is all of a sudden employment is no longer a lagging indicator.
Correct.
It's probably a leading indicator. So I think the most important analysis that could be done are trends in employment going forward.
Agree with that. That's why that was going to be my next question to you was, where does the employment picture play into this? Because obviously the Fed was concerned for a reason. That 4.2, when you really start to break down and look at the numbers, I mean, the trend, I think, is in place. And you get this sort of escape velocity when it comes to the unemployment rate. Once it starts to move, it doesn't really stop. And that could be what derails these things. And I'm glad you brought up, we used to call it value at risk. It's called different things now. But as volatility goes lower, but the flip side of that coin is dangerous, which is why, in my opinion, on this Thursday, as we're taping this, you're seeing an outsized move in the VIX. I mean, you had a VIX that traded almost 25 today on what was historically a pretty benign market day because of, I think, exactly what you just said.
Right. And just let's take it a step further, right? We have some interesting things happening right now. One is we have a government shutdown, right? And in general, I think the government shutdown, the market so far, maybe up until today, who knows, has ignored a government shutdown. I think we will continue to ignore a government shutdown until the market stops ignoring it. And the minute the market stops ignoring it, it'll open up. So it's a really hard thing to play. And what does that do to the market? Chances are Porter gets bullish on that if all of a sudden the government is open up. So the last thing I'll say is I believe Besson and Co. and the Fed understand that the levels of volatility are critical to the ongoing thing of this market. And it's, as a result, it's managed.
Or at least in Argentina it is.
Well,
anyway.
so, and I want to go there in a second, but I'm going to go back to Porter because, again, you're looking at the world a lot differently. We look at it the same way, but you're coming to different conclusions. I mean, and your conclusion is clearly right. But let me ask you a couple questions about some of the other things that are out there. The U.S. dollar, although recently getting back on its horse to the upside, and over the last 6 months sort of trending flat, it's had its worst year in almost 50 years. I happen to think that's a policy thing. I think this is an administration that wants a weaker dollar because they have $39 trillion of debt, and you're not going to grow your way out of it. You're going to deflate your currency your way out of it, which is working. Does that concern you at all? I think you mentioned gold, but I think that's why you're seeing the gold market perform the way it is. And I think at a certain point, something's got to give in terms of just this overall weakness in the dollar.
I agree. Like if you're a wealth manager and you're trying to preserve your client's purchasing power of assets, right? You don't want your key asset going down. And so I look around the world and, I look at China, I look at Japan, and I look at, Korea. All these markets are at all-time highs, right? And it's not just a bull market in the United States, but it's a bull market around the world. I mean, yes, all of us are so concentrated about the U.S., and it's a huge, percentage of global market cap, but there's a lot of reforms happening in Japan and Korea and China, and that they're trying to extract more value out of these companies that trade below book value, right? And so there's a lot of this, the bull market and assets generally is maybe created by a weaker dollar, and so I think there's other ways to explain what's going on, and we're trying to do that.
I look at the geopolitical stuff, Dan, and I say at some point it's got to matter in terms of our equity market. Again, if you had told me the rhetoric around China would have been ramped up to the extent that it is now with Treasury Secretary Besant getting in on it, I'd be like, wow, that's got to be worth at least 5 to 10% over a period of short time in the market. Yet again, markets don't seem to care.
Well, it speaks to the optimism I think that Porter's speaking about is like if you think, and Vinny, you just said this too, if the market doesn't care about a government shutdown, we've all lived through some of these over the last, call it 15 years or so. And we remember there's a lot of trepidation about that in the lead up to it. And then maybe there was a relief when they get kind of solved pretty quickly. As far as the trade war, I mean, we don't really have any meaningful deals. The market freaked out about it, or investors did back in April. They seem just fine with it now. So to your point about China, I mean, this is always been the main event, right? And they had the benefit now, they have the tailwind of passing the tax bill like that they did, right? And that's front end loaded. So you have that sort of spending. We saw a lot of US companies do a lot of that importing before the tariffs went in place. So now you're in the situation where you have this tit for tat. You have Xi, who's not going to lose face, let's be clear. But then on the other side, we have the taco situation. And I think the Chinese have come around to say they know his playbook. Right? They know he's probably one of the worst negotiators that exist on the planet. The art of the deal thing, that's so 50 years ago was a bunch of bullshit too. I mean, like it was, right? He always shoots the hostage. So the investors or the market just believes that that's what's going to happen here. So if they don't care about a shutdown, right? They know they're going to get more rate cuts, and they're not so worried about 100% tariffs, on Chinese goods. I think you can just say, all things good. But to your point, Guy, it's Thursday into the close. We have a VIX at 25. We have an S&P that's about only 2% off its all-time highs. And so if there are any hiccups right here, if the Chinese are playing the long game and they know they just know how Trump's going to be, then I think we have a situation where I think that's going to weigh on, sentiment over here, and I think it's going to make its way into the market.
Danny, I want to pivot to sort of the AI thing. You've seen these sort of Venn diagrams that have been going around for a while, and the circular relationships that now 8 or 9, 10 different companies seem to have. It's eerily reminiscent of things, to your point earlier, what we saw in the late 90s. Again, everybody seems to be saying it's different this time. You study these things. You look at these things and you look at the inner workings of these things. The only thing different this time to me are the names associated with it.
Yeah, listen, it's the math, but no one wants to stop and do the math right now.
Well, do the math. I mean,
listen, the math doesn't work.
Well, he doesn't want to do the math.
I'm good at math.
Do the math. I mean, do the math.
I just know it doesn't add up. I don't need to do the exact. But can I take one step back here? Because there is something that is bigger than all of this that I touched on earlier that I think is the biggest issue. Let's not kid ourselves. It has a lot to do with AI growth as well. Private credit has exploded, okay? It's out of the banking system, okay? So that gives people the relief that, it's not going to take down. Okay, great. Doesn't mean that money was free, okay, effectively for a very long time. You underwrote things at ZIRP, as you've talked about. You underwrote things. So all the things you're talking about, which Taco and all this stuff, the tariffs have consequences. These trade wars have consequences. It's changing the way that small and medium-sized private companies and public have to behave and act. And now you are seeing some of that seep in. What do I mean? Your loan comes up, whether it's an auto part company, whatever it might be, they have been impacted at the margin. There is not a lot of room for a mistake when they're covenant-light loans and they're picking and all that stuff. And so to think that First Brands is a one-off, to think that these things we're seeing at Zion, I know it might be commercial real estate, is one-off. It's not. So if you're telling me that, I'm not saying it's the case, but if you're telling me you were in the first or second inning of not even a credit event, it's a credit, because what coincided also here? The ability for retail to be able to own private credit. You know why that was? Because family offices that we talked to, institutions, they're done. They've allocated. They're no longer putting money into these vehicles. So I see it as a bigger issue there that people are saying, it's not in the banking system, so I don't care. But it has helped this economy function in a way. Money has been free. So I think, and I'll take it one step further. I have friends that are getting data center, prospectuses on their desk to be in a private investment, lock up for 7 years. Someone sent it to me, I go, do you have the in print form? He goes, yes. I go, is it cold? He goes, it's getting there. I go, take it, put it in your fireplace and light it on fire. I go, that's the best use you can have from that prospectus right now.
But that, what you just talked about, it speaks to, what you just talked about, the AI trade is that 50x. I mean, if you just think about the numbers, the absolute numbers that they're throwing around on the AI side of things. I mean, Dan, you mention this all the time. OpenAI, God bless them. In order for them to finance a lot of these things, it goes to back what Danny was talking about.
Well, I think, and I'd love to get your guys' take on this. The AI trade has now become this financial trade. It's become a financial engineering trade. And so to Guy's point, in the last month or so, OpenAI, a company that was just last valued at $500 billion, right, that is not expected to make money for maybe 10 years. So they've really doled out $1 trillion worth of contracts.
And this last mark, by the way, the insiders are selling $11 billion.
Right, it's all secondary, not primary.
So my point is, if you think about where this money is coming from, there's no more equity. Now they're hitting the debt markets, and now they're finding it, into these other products. And so everybody is exposed to this in the S&P 500, right? 40% of this is. You think about the huge hyperscalers that accrued most of the market cap in 23, in 24. Their CapEx is going to slow down. Now it's NVIDIA and it's OpenAI doing all the investing here. And to me, I just think that ends up being a really difficult situation, because if you have companies that are losing money, that are borrowing all this money from equity and from debt, like that's how they're raising it, as sooner or later, it won't take a whole heck of a lot of a slowdown to cause it to go throughout the whole financial system, in my opinion. And that's very different than 99 and 2000.
So, I want to push back a little bit on what you said earlier, and just the way that we think about things is that, our Substack's called Contrarians at the Gate. So we're trying. I'd like to try to be a contrarian.
What are we doing, Contrarians at the Gate?
Whatever.
Yeah.
It's a mouthful, by the way.
Whatever.
Everything else is taken.
Yeah.
RiskReversal was taken.
It's a good name.
So, if I look around the world and there's a big and we say it's the K-shaped economy, but there's the K-shaped stock market too. Mm-hmm. And there's all these stocks that are just getting killed. We took a look at, the Vinny wears the cargo shorts from Abercrombie and Fitch, and the stocks have taken on 52-week lows, and the stock is like 3 times EV/EBITDA. The value guy who thought that 4 times EV/EBITDA can never go lower went to 3, right? And the earnings are fine-ish, but let's imagine we get Xi and Trump. They have this meeting and they're best buds, and they come to some sort of resolution. What does oil do? Right?
What do markets do if that happens?
Yeah. Well, what does coal do? Oh, we're going to reaccelerate, steel making around the world. And so, there are these different scenarios. I know everyone, and we're obsessed with is it a bubble? Is it a not bubble in AI? But like, there are other stuff to do around the edges, say like, and our job is to be prepared for a shift. What happens if that happens, if the Xi and Trump come to some grand negotiation? Because we're going to be buying the hell out of every single oil name, every material name, all this other stuff. Consumer discretion is stuff that's being tossed out right now.
Well, since you mentioned China, let's go back to last summer, I think it was, when Alibaba was an $80 stock and nobody was talking about it. And you both, Danny as well, came on Fast Money, and one of the names that you thought was going to be a name that everybody would start talking about in 2025 was Alibaba, some Chinese stocks, but specifically that name. That stock went on to basically go from 80, I think it printed, I want to say 185 recently-ish. It's pulled back a little bit. Just walk us through the process there, because I didn't see to the extent that you saw it. I talked about it as well, but you guys obviously saw something on the horizon.
Well, one of the first things we saw, again, as Porter said, we're contrarians, right? So take ourselves back then. If you mentioned the word China, you would get disgust, vomit, and the word uninvestable. That's what you would get.
There were articles written about the uninvestability of China.
Correct. And so
Jack Mod, you don't want to get Jack Mod.
What we saw was a company that was trading at 5 to 6 times EV/EBITDA, tons of cash on the balance sheet, no debt, right? And we did it. What if something goes right? And Lord, it did, right? So like, that's what we kind of look for, is that when everyone's telling us this is uninvestable, this sucks, don't go there, we go there.
But man, it wasn't only what happens if it goes right. There were tea leaves around.
Correct.
In the fact that the Xi and has Congress, and he has some of these industry leaders at the pulpit talking, and there were some tone changes around the thing, and said well, that's different. And so Baidu was sitting there trading at cash value, but that stock sucks. So I was like, I don't know, maybe we'll buy cash, and if we get upside, something works. And so that's how we try to, what can go right in some of these other things. I mean, yes, we'll bottom fish and we'll be wrong, but like, occasionally you'll get one of these ones that doubles and triples, right?
So I brought it up because, again, in the context of potential U.S.-China, and I have no idea, but is that sort of the ringing the bell type of thing? In other words, if we were to come out of a weekend where President Trump and President Xi, handshake agreement, we have a deal on the table, and Alibaba goes from 165 to 210, is that where you say, you know what, this is as good as it gets? Are you waiting for that?
That's Milwaukee's best, as good as it gets, right? So, but like in my opinion, the thing is, when people ask me questions, the first thing I go, path dependent. I don't know. Right. And anyone who sits in there and tells you, give this fucking confidence about what's going to happen, they don't know, right? You could say we're going to go down 30%, but I'm telling you, if Xi and Trump go to a 10% tariff,
why are you directing that? It's
going to be wrong, right? So like, I don't know. All I'm saying is I don't know, but we're asking the questions of what if happens and where it is valued relative to the what ifs, combined with other tea leaves, and that's.
It's like me saying it's a bubble. Like I don't know. It looks like one. Yes, there's some, Enron-esque deals around. Yeah, everyone knows that. Like the Gerster and Gurley have a whole podcast. And what is it a bubble? Like, and so if they know, everyone knows, right? And so, they're
not calling it a bubble.
Yeah, but they had Gurley was talking about it, saying it could possibly be a bubble. And so. People know what's going. It's not like they're blind to this stuff.
No, but we're sitting here today. I mean, you look around and it's a target-rich environment, to use a Top Gun term, if you recall that scene, and that was actually a target-rich environment for people like the Danny Moses to say, okay, now things are getting in. Now I'm going to start to really I'm going to start to look under the
medieval.
rocks.
What is it,
Yeah.
stocks? Or are we talking about?
The targets that you guys targeted way back when you did your thing. I mean, we seemingly are getting those when you read about it. Jeffries keeping all that basically liabilities on their balance sheet, playing a little stock market, and seeing how bad things can get. When you hear Jamie Dimon say there's just not one cockroach, I mean, your ears got to start to perk up a little bit.
In 06 and 07, it was very unnatural what the market was doing versus what the core market was telling you. I mean, the core market was the banks and the financials, the mortgage companies. It was unraveling. And so markets were making new highs. It didn't make sense. At some point, you knew they would have to correct. But you play the game while while the music's playing.
And Dan, you've mentioned and you've talked about this. We acknowledge that the larger banks have done well. Excel, whatever you want to look at, J.P. Morgan at an all-time high, although Jamie Dimon said his stock is expensive. They're not buying any stock back at 3 times tangible book. But we acknowledge that Wells Fargo's had a big move. Even Bank of America has gotten itself off the mat. What has not is the KRE, small and mid-cap banks. And you've been quick to point out, look at the underperformance and look at when they topped out a few years ago and look at how poorly it's traded in correlation, not only the broader market, but to its bigger peers.
Yeah, so last night, Wednesday, on Fast Money, we had, how do you pronounce Tom, this CEO of KBW?
Mishaw. Now, remember, Larry
Michaud, are you kidding me?
Guys, I worked at KBW. His name is Tom Michaud.
Okay. Michaud.
Okay,
Yeah.
don't yell at me.
Hold on.
So you remember Larry Michaud, I believe, played at the University of Nevada, Las Vegas, if I'm not mistaken. Dan.
So, as I said, Tom Michaud, and he was on the show, and, he was talking about how this pro-growth agenda, the deregulation, all this sort of stuff. So this is a company that makes most of their money, right, on banking to financial services companies, right? And so he's talking about how this is just a great time for these things. Well, it's Friday into the close, and I see the KRE down 7%, and this is actually, so the BKX was just making new all-time highs. So that's the large caps, right? So we had great numbers out of the investment banks, Goldman, Morgan, and then all the money centers. And so Jamie Dimon, when he was asked about First Brands, he said there's not always just one, right? And I'm going to push this back to you guys, okay? So what I said to Tom was like, okay, we know from our history that if you deregulate and you give banks, okay, enough rope to hang themselves, they will do that, right? And go back to 2018, and you've talked about this, when you change those capital levels for these regionals, right? They took a lot of really dumb risk, and we lost 5 big banks, regionals, in 2023 because of that deregulation. So look at what's happening now. Is this going to be isolated to just a few names? And then I'm going to bring it around here. So all of these, one they call them alternative lenders, right? So we have KKR, Apollo, Blackstone, they're all down 5, 6, 7% today. So there's some investors who are drawing a line between all of this stuff going on right now. And I say to myself, we haven't even gotten to all this crap debt of this bubble that Porter's just talking about in and around AI. There's some problems that are going on under the stuff. So Vinny, help me figure this out, because it seems like the regionals are in trouble right now.
Well, first off, the PE firms, let's go back to 99. The regional banks were down and out because they were considered old economy stocks, right? But they didn't lend to the bubble, right? The people lent in the private equity bubble, generally speaking, are these BDCs, and they're down 20, 30%, and the PE names are down 20 to 30%. But, Guy, I'm going to ask you a question.
Please.
Okay. Who would you say is the best CEO in financial services?
Terry Duffy of the CME Group.
Number 2.
Oh, well, in financial services?
In financial services.
It's. I'll answer this. Probably not the answer you thought I was going to give you. I think David Solomon has done a remarkable job at Goldman Sachs. I don't think
all right,
people.
one that's not a DJ. Okay.
Well, it's got
Non-Chicago,
nothing-
not a
That's
DJ.
a horrible answer, by the way.
Who would?
Who's from Queens, for God's sake?
God.
Well, tell me.
Jamie Dimon, right?
I listen. That's the obvious answer. I started the show
I wanted
by
with
saying
the
he's
obvious.
the most
I
important
know.
banker in the world.
He's pretty handsome, too.
Well,
he's arguably
you know
top
what? I'm
5
gonna push
CEO
back.
in the world. So
Agreed.
when he says things, people listen. When he does things, people will respect the decisions that he makes, generally speaking. Am I right?
Yeah, you're right.
Okay.
Okay.
If I told you that JP Morgan's auto loan and lease origination volume was up 20% year to date. Would you believe me?
Yes.
Okay.
I would believe you. I'm not saying I'm right or wrong, but I would believe you if you said that.
Everyone's crying about how bad auto is and how bad the lending is and how bad the subprime is and how bad and they are. But I got the smartest cat in the room.
Okay.
Growing his originations.
I'm sure they're much now. If you look at auto,
So is Capital One.
If you look at auto delinquency, so across the swath of the United States, I mean, they're growing at a level we haven't seen probably since the financial crisis.
But I ask you,
He knows that.
he knows that.
He's also growing his loan loss reserves, though.
No. Every bank, other than a few idiosyncratic things like Zions and the like, almost every single bank lowered their reserves this quarter. Almost every single bank. Almost every single bank's MPAs were down.
Does that make you feel more comfortable
No.
about the lending
I'm
standard?
just-
But he also did say, Diamond, that the lower-end consumer is facing challenges. He did say it. I'm just
Danny,
saying.
Danny, all I'm saying is when I looked, I ripped through all these supplements the last 2 days. And the rhetoric that I hear is different than the data that I'm seeing, right? And it's actually bugging me out because I do believe in a K-shaped economy. I do believe that the economy is slowing down. But I'm telling you, within the banking system, we haven't seen BDCs yet in the private equity guys report, but within the banking system, particularly for the big boys, the underlying data was fine. I mean, Wells Fargo was off the charts. Scares me how much they're lending to the NDFIs. That's 42% in their C&I loan book. That's freaking
Big.
high, right? And it grew 27%.
Is that a new acronym you just threw out at me?
No, it's the new acronym. And that loan cohort was up 27% year to date. That's a lot. That's where I would be scared. And that's coming to roost. I just don't know exactly.
go
what.
ahead.
Let's since we actually know what we're talking about with financials. I mean,
as opposed to somebody like me
yes.
who's like,
So, the rates are coming down. That's bad for banks, right? That the margin is going to contract anyway. And everyone, all these strategists, I just was listening to some podcasts like, oh, well, we like financials. It's like, well, I mean, they're kind of full valuation. Rates are coming down. They're not really growing the loan book because they suck. And, credit losses are flat to up to down, so look, why am I going to own financials in this environment? I mean, we don't own financials.
And we don't own financials. And Tom Michaud would hate me. I know him fairly well. But regional banks are a structurally flawed business model. They are. Very structurally flawed.
And what happens if the stable coin works and they can, give interest or give some sort of rewards? Like, that's a freaking big deal. That's a pain in the ass. And what did Vin and I just invest in this week, Vinny?
Rocket.
Oh, but different. We invested in this. we invested in a small bank fund, and there is a bifurcation out there. There's all these talk about micro cap, large, anything smaller than a couple $1 billion. No investor looks at it anymore, right? Because the machines don't look there, and no investor, no flows coming down there, and so a lot of these things are half a book value. So, there is stuff to do out there. And like, we wouldn't be investing, I don't think, in a small bank fund if I thought, financials were a disaster.
Right.
I think they're fine.
Wait, are we going to lose any regionals? I mean, look what's going on right
I
now.
think there's going to be massive M&A because they can't compete.
Why wasn't there massive M&A before all these cockroaches were coming out?
Well, there's regulated.
Just 6 months ago or whatever.
Well, there have been some M&A on the surface.
You would have thought in the
There's been a lot of
transition,
M&A.
you would have seen
Comerica just got it.
Right,
Comerica
just happened. I mean, like it takes more than 3 months for these things to happen. We're gonna lose. I would say 500 banks. There'd be 500
of the
bank mergers.
4,800 banks that are out
there's
there.
going to be lots of this stuff.
Okay, but I got a
that's
question
healthy.
for Danny because
Not
we
for
didn't
jobs.
we didn't tie this all together.
You wanna go
right?
back
So
to a
we're
bearish
talking
person?
about
Enough with this.
I'm
Auto's
not-
fine.
I'm
and
not
the
being-
M&A.
We're gonna stay
You go
over
back
here.
here. Go this side. All right.
No, but let's talk about private credit. Who's lending to these private credit funds?
Banks.
Okay, so like for
But, I
instance,
mean,
Jamie
yes.
Dimon is sounding the warning on private credit, right? So help me figure this out.
If you actually listen to Jamie Dimon, he was more worried about his bigger credits and his bigger client counterparties. We all talk about NDFIs and we all look at private equity. NDFI? Non-depository financial institutions. The biggest credit counterparties for JP Morgan, for Bank of America, for Morgan Stanley, for Goldman Sachs, Citadel, Millennium, Jane Street, the quant funds, they all have to mark every single day. The beauty of PE is when they don't like the marks, they just don't fucking do it.
Like Blackstone did with
Two
their,
FYs for Vinny
yeah.
today.
Right? But Ken Griffin has to mark every day. So does Izzy. So does Steve Cohen. Steve Cohen had a bad mark in October, as you know. So when you're levered that much, those, to me, are the bigger risks that no one talks about, right? Everyone talks about those names, and I get why, and I'm not saying. I worry about the levered risk where the gross notional values are in the hundreds of billions to maybe $1 trillion.
Which goes back to
The Mets will
volatility.
never make the playoffs.
Well,
then.
forget
Jesus.
about. I didn't listen. We're 40 minutes into this. I didn't mention the Mets, but since you did, I'll mention
Imagine
the Mets.
if that happened. That'd be like we're already in a bear market.
Mets and Yankees are in the same place
Oh
right
my
now. They're both
God.
watching.
Okay, do you want to go there? Do
No,
you really
I don't
wanna
even
play
care.
that
I'm
game?
indifferent.
But
No.
guys, is it too easy to connect all of these dots right here with what we're seeing in the regionals, what we're seeing in private credit, private equity, who's loaning to who? Think about also what's going on with the valuations and the AI in the private markets. Where do all the VCs raise this capital from? Pension funds, sovereign wealth fund. So it's all becoming very, very, I know we're using the term circular as it relates to, the AI stuff, but I think there's so many dots to be connected right now. And it seems like it's very different. And then you think of the leverage and like crypto and all this.
If you want Vinny and I to get dark and Danny to
Yes.
get dark, we can get dark pretty quickly
Please.
because,
there's
they're-
plenty of bullish podcasts
they're
out
gonna
there, by
they're
the
gonna
way.
bail out everything because it's too levered. It's too important. The economy sucks anyway. Imagine if they
Dude, one hedge fund manager blowing up in Argentina just got $20 billion by making one phone call.
Yeah,
So, I mean,
America
come on.
first.
imagine if the S&P went down 50%. I mean, this economy would be a disaster.
Can I go back to
If
what
it goes down 50%, it's probably going more
So
until they print the money.
So think about who you just talked about, the people that have to mark each day without question. You also mentioned that as volatility goes lower, it gives them basically more rope to hang themselves. Are we setting up for a volatility event? Because I will tell you, the move in April that we saw did not justify a VIX going north of 65 historically. There's obviously something brewing below the surface. Thoughts on that?
I think it's the degree of leverage. And I think get used to it. This is what we're going to see because a sizable portion of the alternative investment publicly traded pool is levered 5 to 6 to 1. So if the world doesn't go the right way, we're going to have vol shocks and we're going to have shocks to the market. But sadly, I think that the Federal Reserve knows that and tries to target volatility. It's the one thing you'll never hear a mandate targeting volatility, but I'm fairly certain that they're doing
It's already
that.
begun.
Yeah.
The end of QT. So we knew that.
Right.
The reserves are perfect. 6.6
So what
trillion.
would be a vol reducing moment? So look, in general, when the VIX gets to 14 or 15, I start getting skittish
Right.
about the market. When the VIX gets to 30 or 35, you start getting bullish on the market because they're coming, right? What's the next thing that can come? Government opens up, right? Trump.
Gold's telling you that already.
Trump
Gold
caves.
is
right.
giving you
I'm
all
with
of
you.
this.
I
Gold
agree.
is describing everything that we're talking about. It's sucking up everything else that's wrong. It's going into gold. Gold's $30 trillion. It's gone from 20 to 30 trillion. That's a $10 trillion move here. I mean,
it also sees the dysfunction about this country. I mean,
it's not just ours. It's Japan. It's everywhere. How are you getting out of this?
You guys say you're not looking at the market. Didn't
I'm gonna have
you just
to
say that
embarrass
like 25? No.
You try.
You're trying. So Guy just mentioned you got a 25 VIX. You got gold that's just gone up 35% in a straight line, over the last couple months or so. You have a dollar that's obviously can't get out of its own way. You have a stock market within 2% of the all-time highs. All of those concentrated, names there. You talk about passive investing. It seems like it's an accident waiting to happen. I mean,
for our Substack subscribers, we have a little podcast called the Friday Night Dirty, and we've been talking about it this for a while, and the uneasiness that we've all felt. Right? There's a time to be bullish. There's a time to be bearish. And I've been saying there's a time to keep your head on a swivel. This is like head on a swivel time. And as I played the contrarian bull here for a couple of minutes, but anyway, so I'm trying to stay balanced, try not to get blown up either way, but and then stay in positions that I like. But there are a lot of risks out there, and as we all talked about. So
I mean, this has been a lot of fun for me. The great Vinny Daniel, Porter Collins, the Olympian, Dan Nathan,
not an Olympian, Danny
the
Moses.
shitty golfer,
Yeah.
Danny Moses. Thanks for joining us. We're going to stick around with you guys. This ends this podcast, but we're going to do something in preview of next week, folks. So check out our Monday drop of the Risk Reversal Podcast. I think you'll enjoy it.